What is going on, everyone? Hope you all are doing well, and in this video I'm going to share what I'm going to be looking at for Shift Technologies during this next earnings call. I've talked about this one several times on this channel, and with it being a couple of months since I've last posted, this could be a good opportunity to show both the caution flags and the things that I like about this company. So sit back, relax, and destroy that like button. Well, I guess you probably can't relax and destroy at the same time. So sit back, relax, and gently put the like button to sleep. Thank you so much. With all that said, let's go ahead and dive right in. Okay, so before we get into the actual earnings call, let's talk about the price action. Shift hit an all-time low of 60 cents back on June 16th. And since then, this stock has been on an absolute tear, moving up almost 90% and then falling about another 8% on Friday. So if you were buying at the lows, congratulations, because those shares are still up a ton. However, I think for many of us, even though this run was massive, we are still down on our shares. So these next few quarters are going to be critical for us as investors on whether Shift is going bankrupt or if they're going back to where they were and even further than that. So let's look at some of the things I'm going to be paying close attention to in this upcoming earnings report. For Q2 revenues, I think it is extremely important that we see Shift meet their expectations between $225 million and $235 million. Now, analysts have the company doing $233 million, and from what we have seen in the past, the company continues to outperform their expectations. But this quarter does give me cause for concern, and here's why. With analysts having higher expectations, it becomes much more difficult to beat. And so even if we hit the company's estimates, we could still see prices drop because they missed on analyst expectations. However, Shift has continued to beat their revenues expectations over the past year, and I wouldn't be surprised if they did it again. I think anything under 228 would be disappointing for the company because of the bar that they have set for their revenues. But the same thing cannot be said for EPS, or earnings per share. And this is where I'm going to spend most of the time when I'm reviewing their earnings report and conference call. There are a few things that affect EPS, but for short, to find the EPS with growth companies that don't have a dividend, you take the net income and divide it by the total number of shares outstanding. Now, the total number of shares, I'm not going to worry about, but the net income is going to be key, especially with Shift being a non-profitable company. So here are a few metrics that are inside the net income that I will pay close attention to. The first one is the second quarter GPU, which is their gross profits per unit. One thing that I've said numerous times that is a caution flag with Shift and other used car e-commerce companies is that they have razor thin margins. So improving gross profits are extremely important. Now, there are two pieces to GPU. One is the actual car itself through buying the cars from consumers, doing the maintenance, and then selling them on the market. But the second piece, in my opinion, is the most important, and that is their adjusted other GPU. When you think about the car industry, there's only so much you can do to add value to the vehicle. So you need to rely on services outside of the car itself. And that is where this other GPU comes in. This category includes the term F&I, or financing and insurance. I guarantee you that this will be a topic of discussion on the conference call, because not only am I one of those people who pays close attention to this specific segment, but several of the large investors do as well. And it makes sense as to why. If Shift wants to become a major player, they have to utilize their financing and insurance levers to not only grow revenues, but most importantly, grow margins. So here are a few numbers that I'm going to be looking for. First, I want to see them meet their expectations with GPU, somewhere between $1,800 and $2,000. This will be significantly higher than their Q1 numbers, so I really think that this will be an important metric for several investors. But within the GPU, the amount that I want to see with their adjusted other GPU is about $1,300, which is similar to Q1 numbers. In the current economic environment that we are in, it is difficult to gauge how their financing and insurance will be affected by this. However, for myself, it is not specifically the number that I'm looking for, but it is actually their progress for getting more customers using their financing and insurance. Although if I see this number under $1,000, then this could be cause for concern. So GPU is one important metric to look at when it comes to EPS. But the second is their adjusted EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. This is the metric that I like to use to get an idea on how they are doing with moving toward profitability. The numbers that Shift estimated for the quarter are between negative $37 million and negative $39 million. Over the past year, the company has either met their own expectations or beat it. And so I'm expecting a very similar result. Now, one of the biggest things that I've talked about previously as a caution flag is the cash burn for the company. And I will be talking more about that later. But I think one metric many people miss when it comes to adjusted EBITDA is the margin when you compare it to the revenues. Because even though the company had a much lower adjusted EBITDA last year, the percent of revenues has significantly significantly improved. This means that their operating expenses are lower in relation to the total revenue, leading toward more capital to grow the business and work towards profitability. And this all leads to cash burn, which has been the talk of the century for Shift. There were a number of people that sold over the past earnings call because of this one metric. And yes, their cash burn did not look good, but we need to remember the reason. The two major reasons are the $38 million investment in their inventory and the annual incentive payment for their 2021 performance. So first, the inventory. We know that they are going to constantly need to buy inventory to keep up with demand, but the amount that they're adding is not going to be as significant in Q2. The other thing to consider that was mentioned in their conference call is that the cash use is expected to be reduced significantly for the coming quarters as they convert the high point of inventory achieved in Q1 into sales and cash. So even though they spent a lot of money on their inventory, I do believe we'll not see cash burn like we saw this previous quarter. And the second reason I think this is because they don't have as many incentive payments for the rest of the year. To be clear, many companies do incentive payments in Q1 because it tends to be based off of the physical year. And when you completely destroy your revenue expectations by 30%, I think it's fair to say that it wasn't a horrible decision. Now, if they barely met expectations, that is a completely different story. But when we consider that these annual payments won't be as frequent for the rest of the year, I do not see cash burn being anywhere near $100 million like we saw in Q1. Honestly, it is hard to come up with a precise number given that we simply don't know how much in inventory they are buying and moving into cash. So for this upcoming quarter, I will look at the cash burn, but most importantly, how it is being used this quarter in comparison to last quarter. So real quick, before we move into the next thing, I think we can all agree that Shift is a high risk, high reward play. And that is why we can accept some of the caution flags that exist with this company. Regardless, I do not want to put all my money into one stock, especially a company with a high risk. But just like stocks, I like to diversify my brokerages too. I've tried several different platforms, but one I really like using is Moomoo. They're doing a promotion right now where you can get up to 7 free stocks when you deposit $100 to the platform, or 10 free stocks when you deposit $2,000 to the platform. And these stocks could be valued up to $2,500. Think about it. That's literally free money for you. As someone who has used multiple platforms, the Moomoo app is a really clean and easy app to use. You can buy stocks both on the US stock market and the Hong Kong market as well. Plus, there are no fees for trading US stocks if you are a US resident, and if you enjoy technical analysis, which I know several of you do for a company like Shift, they have free level 2 data as well. So if you're interested in using Moomoo, click the link down below in the description to get started. This promotion only lasts until the end of July, so make sure that you sign up before it ends. The third thing that I'll be looking out for is an update on the Fair acquisition. Now, we do know that they closed the deal back in May. They did say that the launch is supposed to happen in Q2. What I'm going to be looking for with this deal is not only the progress, but how the business will utilize it to work on profitability and building brand awareness. If I'm honest, I don't think we're going to get much information because, as I said, they did just close this in May. So I'm sure there's not enough data out there to really explain the effects of this segment. But I do think that there could be news of the launch of Fair, or at least an update as to how it will be better integrated into the current business. And the last few things that I will be paying attention to is their guidance or outlook. With the possible recession on the horizon, there could be less people wanting to buy cars. And so what is the environment going to be like for Shift if we begin to see demand fall? They have announced that they are focusing on the regions where they already have a hub. So this could be a way for them to protect themselves from higher operating costs if they begin to lose demand and therefore revenues. So I really want to see them maintain their guidance numbers. Their revenues for 2022 should be between $1 billion and $1.1 billion. Analysts expect them to be more on the lower end of their expectations. I wouldn't be surprised if there was a demand decline, but I think the biggest question for Shift is, will they be able to execute on their projections even during the decline? Or will competitors like Vroom and Carvana overtake them because of their brand awareness and recognition? And of course, only time will tell when it comes to their revenues. The second part of their guidance that I'm looking at is if they will maintain their adjusted GPU, which is projected to be greater than last year. Now, this one is going to be dependent on their F&I, because if we do see demand fall, so will the prices. And the appreciation we saw in used cars over the last year will not be able to carry them to profitability. So will their F&I be affected even in a crazy economic time? The last metric for their guidance is their adjusted EBITDA margins. I really think we won't see the numbers to support these kinds of margins until Q3 or Q4. But once again, only time will tell. Now, I know that there are plenty of people saying that there's going to be a short squeeze for Shift. and maybe it will happen. But I'm not putting my chips in this company because of a short squeeze. I'm invested for the long term. However, I recognize that this is a risky play, and this is a major reason why it is one of my smallest positions in my portfolio. There is a possibility that this company could go under. Of course, I don't believe that it will happen because I bought shares of this company, but please know your risk tolerance before investing. But hey, if you enjoyed this video, follow me on Instagram at JonnyOswald64 to see more content where I talk about budgeting, investing, and building wealth. Also, don't forget to sign up with Moomoo where you can get up to 7 to 10 free stocks depending on how much you deposit to the platform. And I would love to hear what you think about Shift, whether or not you think they'll go bankrupt or if you think the company will go places. So let me know your thoughts in the comments down below. And if you're new here, smash that subscribe button and notification bell, that way you're notified when new content comes out. Hope you all enjoy the rest of your week, and I'll see you in the next one.